Welcome to Demystifying Deferrals, a presentation of Carr, Riggs, and Ingram, or CRI. CRI is dedicated not only to providing the highest quality service to its clients, but also to contributing to the public discourse about governmental accounting, financial reporting, and accountability by making free educational resources available to anyone who wants to learn more about government finances. On CRI's website, criadv.com, you can find short articles on a wide range of relevant topics, reference tools, podcast episodes, and presentations like this one. Hi, my name is Dean Mead. I'm a partner and government and public sector subline leader at CRI. Before joining CRI in 2022, I worked on the staff of the Governmental Accounting Standards Board, or GASB, for 24 years, most recently as Assistant Director of Research and Technical Activities. I was at the GASB when the standards related to deferrals were created, so I've learned a thing or two about them over the years. I'm excited to share my insights with you. This presentation covers the basics of deferrals, what they are, where they came from, why governments report them, why they are important, and how to understand them. We'll also talk about the other materials CRI provides to help you understand deferrals, including plain language articles, slide decks, brief videos on key topics, exercises and problems for teaching deferrals, and an ebook that pulls all of them together in one easy-to-download resource. CRI is working to clear the air about deferrals because they are a unique and important aspect of state and local government accounting that financial statement preparers, auditors, and users need to comprehend. No aspect of governmental accounting may be more bewildering to those working in the public sector than deferred outflows of resources and deferred inflows of resources. The mere mention of deferrals seems to create a fog that envelops the minds of otherwise intelligent people, including experienced and knowledgeable auditors, government finance officers, and municipal bond analysts. So it's no wonder that people new to governmental accounting are also bewildered. If you are unfamiliar with the financial statements of states, counties, cities, school districts, and other governmental entities, you may see something that you've never seen anywhere else. In addition to assets and liabilities, essentially things a government owns and amounts it owes to others, a government's balance sheets probably also include separate sections for deferred outflows of resources and deferred inflows of resources, items that are unique to governmental financial statements. But where do they come from? Did the GASB, the organization that establishes accounting standards for state and local governments, just invent them? Well, of course not. What the GASB did do was to put a name on things that had been reported among the assets and liabilities in financial statements for many years. The GASB not only issues statements that contain standards of governmental accounting and financial reporting, it also publishes something called concept statements. GASB statements contain the requirements of generally accepted accounting principles, GAAP or GAAP, that governments follow when they're preparing their financial statements. Concept statements, on the other hand, are primarily intended to guide the GASB itself as it develops statements and other pronouncements containing standards. Just as statements help to ensure consistency in governmental financial statements, the concept statements help to ensure consistency in the GASB's standards. The concepts provide definitions and criteria for things like where in the financial report information should be reported and how the amounts reported should be measured. Back in the early 2000s, the GASB was working on a concept statement that would define the items that are reported in financial statements, including assets, liabilities, revenues, and expenses. Those definitions are important in order to account for similar transactions the same way. If one transaction results in a government reporting a liability and an expense, a similar transaction generally should have the same accounting outcome. The result of that project was GASB Concept Statement number 4, Elements of Financial Statements. The development of Concept Statement 4 involved the GASB examining every item that was then being reported in governmental financial statements and comparing them with the tentative definitions for assets, liabilities, inflows of resources, which typically are reported as revenues, and outflows of resources, which are typically reported as expenses and expenditures. Most of what was then being reported in financial statements matched one of those four categories. However, the GASB also found items that were reported among assets, liabilities, inflows of resources, and outflows of resources, but didn't meet any of those definitions. Those are the items that the GASB labeled deferred outflows of resources and deferred inflows of resources. Maybe you're asking why the GASB thought it was a problem that these so-called deferrals were being reported as assets and liabilities. As we will see, deferrals clearly are not things owned or amounts owed. So treating them as such may make it look like a government has more resources or has bigger debts than it really does. A common example of this was something called deferred revenue. Before the GASB developed concepts and standards for reporting deferrals, deferred revenue was reported as a liability, but often was actually a combination of liabilities and future revenues. Deferred revenue might have included liabilities such as unearned income and grants received in advance, amounts that a government received before it provided services or did what was necessary to be eligible for the grant. Such amounts are liabilities because if the government doesn't provide those services or meet the grant eligibility requirements, it has to give that money back to the customer or the grantor government. In addition to liabilities like those, deferred revenue reported in the governmental funds balance sheet also included unavailable revenue. Unavailable revenue is not an amount owed. It is actually a portion of this year's revenue that was not received during the year or soon enough after fiscal year end to be available to pay for this year's expenditures. Deferred revenue also included future revenues, such as property taxes levied for the next fiscal year. That, too, is not an amount owed. It's just next year's revenue. Before the advent of deferrals, that single liability amount called deferred revenue made it appear that governments owed more than they really did and, therefore, look less financially healthy. When the GASB first proposed what would become Concept Statement 4, these four elements of financial statements are what everyone expected to see: assets and liabilities in the balance sheets and statements of financial position, and outflows and inflows in the income or resource flow statements. But the GASB identified two more elements that were pretty much a surprise to everyone: deferred outflows of resources and deferred inflows of resources. These definitions are very similar to those we just saw for outflows of resources and inflows of resources. They involve resources being used up or flowing out of a government, or resources being obtained by or flowing into a government. The difference with deferrals is that they relate to a future year, a year in which they will be reported as revenue or expense in the income statements. Until then, they are reported as deferrals in the balance sheets. The distinction might be even clearer if we insert current into the definitions of outflows and inflows of resources. Those are reported as revenues and expenses now rather than in the future. Okay, let's deal with the elephant in the financial statements. The GASB itself probably caused some of the confusion about deferrals by naming them the way they did. In their defense, they wanted to avoid any confusion with the liability that was then being reported as deferred revenue. But in retrospect, I think we would have been better off calling them deferred revenues, deferred expenses, and deferred expenditures. The names that the GASB gave them instead, deferred outflows of resources and deferred inflows of resources, seem to suggest that there has been a delay in resources like cash and promises to pay flowing into and out of a government's coffers. But that's not the case. Just like the flows that are reported right away as revenues and expenses, the flows that initially are reported as deferrals did happen during the year. The difference is that they won't be reported as revenues and expenses until the future. The inflows and outflows that occur this year, but are reported initially as deferrals, will eventually be reported as revenues and expenses in most cases. I like to think of them as revenues and expenses that are just waiting for their moment to shine. Their purpose is to make sure revenues and expenses are reported in the correct year. There also are a few deferrals that may result in no revenue or expense ever being reported. They are meant to avoid overstating or understating revenues and expenses. Throughout the year, a government receives payments, and most of the time they relate to this year. As a result, they usually are recorded as revenues in the government's income statements. Occasionally, though, a payment received in the current fiscal year actually relates to a future fiscal year. Those inflows are recorded in the government's balance sheets as deferred inflows of resources until the future fiscal year arrives. And at that time, the revenues are recorded in the income statements. Similarly, throughout the year, a government makes payments, and most of the time they relate to this year. As a result, they usually are recorded as expenses or expenditures in the government's income statements. Occasionally, though, a payment made in the current fiscal year actually relates to a future fiscal year. Those outflows are recorded in the government's balance sheets as deferred outflows of resources until the future fiscal year arrives. And at that time, the expenses and expenditures are recorded in the income statements. In other words, it's not the inflows and outflows that are postponed, like their names suggest. It's the recording of them as revenues and expenses that is postponed until a future fiscal year. That may be a lot to grasp with just words. So let's take a step back and walk through it again visually. During the course of the fiscal year, a government receives cash, a promise to pay, or some other kind of resource. Most of the time, that inflow of resources relates to the current fiscal year and therefore will be reported as revenue in this year's income statements. Sometimes, though, that inflow of resources relates to next year or some other fiscal year down the road. When that happens, a government initially reports the inflow as a deferred inflow in its balance sheets, and when the appropriate fiscal year begins, the government removes the deferred inflow and reports revenue. The same is true for the flip side of the transaction. During the course of a fiscal year, a government gives cash, a promise to pay, or some other kind of resource to another party. Most of the time, the outflow of resources relates to the current fiscal year and therefore will be reported as expense in this year's income statements. Sometimes, though, the outflow of resources relates to next year or some other fiscal year down the road. And when that happens, a government initially reports that outflow as a deferred outflow in its balance sheets. When the appropriate fiscal year begins, the government then removes the deferred outflow and reports expenses. You might respond to the preceding slides by saying, deferred outflows of resources sound a lot like a prepaid asset. And you'd be right, they are similar. If a government pays 6 months of rent in advance for office space, it initially reports an asset called prepaid rent. Over time, as the government occupies that space, the prepaid rent asset is reduced and rent expense is reported. That does sound a lot like the descriptions we've talked about for deferred outflows. However, as an asset, prepaid rent is a resource that provides service capacity that a government can use for operations or to provide services. The government also might convert it to cash by subletting the office space to someone else. A deferred outflow has none of those properties, however. It can't be used to provide service, it doesn't generate income to finance the provision of service, and it can't be sold to produce income. A deferred outflow is only an expense waiting for the right period to be reported. You might also think, hey, deferred inflows of resources sound a lot like unearned income. And you'd be right, they are similar. If a government receives 6 months of rents in advance from a company for the use of a public facility, it initially reports a liability, which might be labeled unearned income. Over time, as the company occupies that facility, the unearned income liability is reduced and rent revenue is reported. That does sound a lot like the descriptions we've seen so far of deferred inflows. However, as a liability, Unearned income represents an obligation for the government to allow the company to use the facility for the next 6 months, during which the government itself can't use the facility. A deferred inflow, on the other hand, is not an amount owed to another party or some other kind of obligation. It doesn't mature, and it doesn't require the government to sacrifice resources to satisfy it. A deferred inflow is only a revenue waiting for the right period to be reported. So let's recap. A deferred inflow of resources is an inflow that has already occurred, but it won't be reported as revenue until the appropriate future period. And a deferred outflow of resources is an outflow that has already occurred, but it won't be reported as expense or expenditure until the appropriate future period. Congratulations! We're all experts on deferrals now. Okay, maybe not yet. But hopefully you've got a better grasp on what they are and how they differ from the other items reported in the government's financial statements. Let's talk now about why it's important that these items be reported as deferrals and not as other financial statement elements. I've lost track of the number of times someone has asked me, why can't we just put them back where we found them? It doesn't satisfy them to answer that deferrals are not assets and liabilities and we shouldn't pretend they are. And really, the reasons are more significant than that anyway. Deferrals perform vital functions in governmental accounting that help to achieve important objectives of reporting in financial statements. In general, deferrals serve two major purposes. They help to put revenues and expenses in the right years, and they help to make sure revenues and expenses are reported in the correct amounts. Why is it important that revenues and expenses are reported in the right years? Well, in addition to the general need to report finances accurately, putting revenues and expenses in the years they belong to helps to achieve one of the key objectives of government financial statements, helping the reader to figure out if a government is living within its means from year to year. In other words, balancing its checkbook. The fancy accounting term for that is interperiod equity. Governments may not need to run a profit, but they do need to raise enough money each year to pay their bills. The alternative is draining their savings, which may leave them vulnerable in an emergency, or pushing costs off to the future, which tends to make things more expensive and results in future taxpayers paying for services they didn't receive. Deferrals help to ensure that the revenues and expenses reported in each year's financial statements are only that year's revenues and expenses. That's how they help you accurately assess interperiod equity. Additionally, some deferrals are needed to make sure revenues and expenses are reported in the right amounts. As we'll see, they function by either never becoming revenues or expenses, or by offsetting each other to avoid overstating or understating revenues or expenses. These are all of the transactions for which deferrals are reported. Those in the blue box you will see in the financial statements of most governments. The ones in the other box relate to less common transactions. One of the deferrals resources CRI has developed is a slide deck that gets into the technical details of every one of these deferrals. You can find it on the website and in the ebook. For this presentation, we're going to look just at the more common deferrals. Let's start with the more numerous kind of deferral, those that help to make certain that revenues and expenses are reported in the right year. Some governments will establish their property tax levy for the following year toward the end of the current fiscal year as part of the process of adopting next year's budget. The accounting standards say that when a government is legally entitled to receive property tax payments, it should report an asset, property taxes receivable, and property tax revenue. Establishing the property tax levy often gives governments that legally enforceable claim immediately. But is that what we want to happen if the property tax levy in question is next year's property taxes? Can we all agree that next year's property tax revenues should be reported next year, not this year? That's where deferrals come in handy. For example, in November 2025, a government establishes its property tax levy for its fiscal year starting January 1st, 2026, in the amount of $12 million. The enforceable legal claim to the property taxes arises in November 2 months before the fiscal year for which the taxes were levied. Instead of reporting 2026's property tax revenues in 2025, the government reports a deferred inflow of resources to go with the property taxes receivable until the next year begins. At that point, the deferred inflow is eliminated and the government reports its property tax revenues. Now, you might say, if that happens every year, what's the big deal? It's not as if they're reporting 2 years' worth of property tax revenues in 1 year. And you'd be right. But if you're going to determine whether a government has balanced its checkbook, you want to be sure that the government is reporting its property tax revenues in the same year as the expenses they were levied to pay for. After property taxes, grants from other governments may be the most common revenue source for many governments. A lot of grants are expenditure-driven, meaning a government generally has to spend first on things allowed under a grant program, then report the spending to the relevant state or federal agency before getting the grant money. The accounting standards say the recipient government should report an asset, grants receivable, and grant revenue when it has met the program requirements by spending on allowable costs. When it finally gets the money, it removes the receivable. Sometimes a government receives the grant money before it has met the program's eligibility requirements. Not a lot, but sometimes. In this case, when the cash is received, the government reports a liability because if it never fulfills the requirements, it will have to give the grant money back. When it meets the requirements, it reports the grant revenue and eliminates the liability. Occasionally, when a government receives grant money after meeting a program's eligibility requirements, the money comes with a time restriction that prohibits the government from spending the money until a future year. Alternatively, a government might receive a grant that has no eligibility requirements but does have a time restriction. When either of those circumstances arises, a government should report a deferred inflow of resources until the future period when it is allowed to spend the money. At that time, it reports the grant revenue and it gets rid of the deferral. For example, during fiscal year 2024, a county receives a state grant with no eligibility requirements. However, the state says it can't be spent until fiscal year 2026. Until fiscal year 2026 begins, the county reports a deferred inflow, and the state reports a deferred outflow. When fiscal year 2026 begins, the county reports the grant revenue and eliminates the deferred inflow. And at the same time, the state reports a grant expense and eliminates its deferred outflow. Governments that prepare financial statements for governmental funds, like the general fund, report a deferral related to unavailable revenue. Unlike those other financial statements, the governmental funds use modified accrual accounting. One of the modifications is that revenue is reported only if payment is received during the fiscal year or soon enough after fiscal year end to be used to pay the current year's expenditures. If payment is not received during that period of availability after fiscal year end, the amount is reported temporarily as a deferred inflow. Generally, in the next fiscal year, when payment is received, the revenue is reported and the deferral removed. Let's look at an example of this for a property tax. That is the only revenue source for which the standards define the period of availability, 60 days after fiscal year end. Governments are required to establish periods of availability for other revenue sources and to disclose them in notes to financial statements. In this example, the government has a property tax levy of $50 million for fiscal year 2025. It collects $47 million during the fiscal year or the 60 days after fiscal year end. All of that should be reported as revenue. The remaining $3 million that is not collected during the year or within that 60-day period of availability is reported initially as a deferred inflow. The timing related to unavailable revenue can get a little bit more complicated with grants because, as we've seen, the date when money is received typically is not the same date when the government is required to report revenue. In this example, a township spends on allowable costs under a state grant program throughout the year. It generally takes the state 120 days to make payment once it's notified by the township, and the township uses a 60-day period of availability for reporting in its governmental funds. Because it takes the state so long to pay, only the eligible spending through October is considered available and reported as revenue in the governmental funds during fiscal year 2025. The township won't receive payment for any spending after October 2025 until March 2026, which is beyond the period of availability. Reporting of revenue for eligible spending during November and December 2025 is deferred until payment is received during 2026. It's worth noting that this only happens in the governmental funds under modified accrual. In the government-wide financial statements, which use full accrual, all of the revenue that a government is entitled to and that is collectible is reported as revenue. Availability isn't a factor. Some deferrals that help to get revenues in the right year relate to transactions that stretch over multiple years, such as sales of future revenues, leases, and public-private partnerships. It's not unusual in some of these transactions for a government to receive a significant payment up front, maybe even the entire amount that it's going to be paid, even though the arrangement lasts for 5, 10, or even 50 or more years. Assessing interperiod equity depends on the accounting to ensure that each year of the arrangement gets its share of the revenue, which is accrual accounting, regardless of when the government actually gets paid. Let's say a government enters into a transaction to lease one of its facilities to a business for 10 years, starting next year. As part of the deal, the business pays the government $10 million up front. When should the government report the $10 million as revenue? Right away? That's this first row here, $10 million in the year before the arrangement actually begins, and no revenue at all for the next 10 years. Or perhaps it should be in the first year of the arrangement. That's this next row in purple. All the revenue in year 1 and no revenue in years 2 through 10. Or evenly over the term of the lease. That's this third row in green. $1 million is recognized in each of the 10 years of the lease. So which is the right answer? The accounting standards say over the term of the lease. Why? Well, what is the business buying with that $10 million? It is part of the cost to rent the government's facility for the next 10 years. In other words, the government will be earning the upfront payment as time passes and the business occupies the facility. Therefore, the upfront payment should be reported as revenue as the government earns it. Governments use deferrals to ensure that the third option is taken. In the preceding example, the government initially will report the $10 million upfront payment as cash and a liability to the lessee, because the money has to be given back if the lessee never gets to use the facility. When the lease begins, the government will replace the liability with a deferred inflow of resources. And then in each year of the lease arrangement, the government records lease revenue and reduces the deferred inflow by $1 million each, until by the end of the arrangement, all of the revenue has been recognized and the deferral is gone. That is also how lease accounting uses deferrals even when there is no upfront payment. Let's say a government leases a building to a business for 5 years, with the lease term starting on January 1, 2026. The government lessor reports a lease receivable for the payments it will receive from the lessee during the lease arrangement, as well as a deferred inflow of resources. Then, in each year, the government records lease revenue and reduces the deferred inflow by equal amounts. A service concession arrangement, or SCA, is a type of public-private partnership in which a government, referred to in the standards as the transferor, enters into a long-term agreement, often lasting 50 or more years, in which a business or another government operates and cares for an asset of the government, such as a toll road or a convention center. The government gets a sizable payment up front, and perhaps more payments over the course of the SCA, and the operator, the business or the other government, gets to keep the fees charged to the users of the asset, say drivers on the toll road or groups that rent out the convention center. Some SCAs involve the operator constructing a new facility, which will revert to the government at the end of the SCA. In other cases, the SCA involves an existing asset of the government to which the operator likely will make improvements, such as adding express lanes to a toll road or expanding and refurbishing a convention center. If the operator builds a new facility or improves an existing facility of the government should report the new or improved facility as a capital asset, a liability for anything it promises to do for the operator during the SCA, and a deferred inflow in the amount of the difference between the asset and the liability. Regarding the upfront payment, as well as any installment payments that may be made to the government during the SCA, the government should report cash and/or a receivable, a liability for anything it promises to do for the operator during the SCA, if it hasn't already done so related to the new or improved asset, and a deferred inflow in the amount of the difference between them. In each year of the SCA, the government will then recognize revenue and reduce the deferred inflows, just as we saw for the lease example. Our examples thus far have been almost exclusively revenue transactions. So let's take a look at the use of deferrals to make certain that expenses are reported in the correct years as part of a debt refunding. Governments often issue new debt to replace older debt in order to reduce the cost of repaying the debt. For example, a government may have outstanding debt with an interest rate of 5%, but market rates have fallen to 4% recently, so the government issues new 4% bonds to repay the old 5% bonds. Governments also may engage in a debt refunding to stretch payments over additional years or to get out of restrictive covenants, such as expensive repayment provisions. In the very simplified example here, a city issues $14 million in new bonds to refund outstanding bonds of $15 million. That produces an economic gain for the city of $1 million, the difference between the outstanding debt and the amount required to redeem it. Rather than report the entire gain when the refunding happens, the accounting standards say the city should report it as a deferred inflow initially, and then, over the shorter of the remaining years on the old or new debt, the city would reduce its interest expense and the deferred inflow by equal amounts. In this example, both the old and new debt have 20 years remaining. So let's see what that example looks like. The city removes the old bonds from its accounts, adds the new bonds, and reports a deferred inflow of $1 million for the economic gain on the transaction. And then, for each of the remaining 20 years on the bonds, the city reduces interest expense and the deferred inflow by $50,000, or $1 million divided by 20. Let's imagine instead that the city needed to issue $16 million in new bonds in order to refund the outstanding $15 million. That would produce an economic loss of $1 million, which the city would report as a deferred outflow. In each year, then, the city would add $50,000 to interest expense and reduce the deferred outflow. When you look at a government's financial statements, you're likely to see both deferred outflows and deferred inflows related to pensions and other post-employment benefits the government provides to its retired employees. By the way, other post-employment benefits, or OPEB, are the benefits other than pensions that governments provide retirees, most commonly health insurance coverage. When you see a single amount for a deferred outflow or a deferred inflow of pensions or OPEB, it's probably an aggregation of several different deferrals. Those pension and OPEB deferrals result from annual increases or decreases in the pension and OPEB liabilities that governments report in their financial statements, some of which are initially reported as deferrals and then reported as expense over multiple years. We explore this topic more deeply in the fourth of 5 short takes videos, but in broad strokes here, The biggest increases in the pension and OPEB liabilities each year are reported as expenses right away. The normal cost, which is the value of new benefits earned during the period, and interest on the beginning balance of the liability. The effect on the liability of improvements to benefits or reductions in benefits also are expensed right away. All other causes of changes in the liability are reported first as deferrals and then as expense over several years. All but one of those is reported as expense over a period that equals the average remaining years of service of all members of the pension or OPEB plan, both active employees and people who were already retired. Those are examples of pension and OPEB expenses waiting for the right period to be reported. The other deferral relates to the effect on the liability of differences between what the government assumed the pension or OPEB plan's investments would earn and what it actually earned for the year. Measuring a pension or OPEB liability is a very complex calculation that uses assumptions about things like how long employees will work, what their salaries will be, and how long they will live and collect benefits after retirement. Another assumption in that equation is the average annual earnings on the plan's long-term investments. But in any given year, actual earnings will likely be higher or lower than the assumption. Higher than assumed earnings produce a deferred inflow. Lower than assumed earnings produce a deferred outflow. This deferral is expensed over a 5-year period. This is the other kind of deferral, those that offset or may never be reported as expense. The last deferral shown here is unrelated to expense. Briefly, for practical reasons, the liability that is reported in the financial statements for, say, June 30th, 2025, can be measured as of a date as early as 1 year before, that is June 30th, 2024. Because of that difference in dates, any contributions to the pension or OPEB plan after the measurement date are not reflected in the reported liabilities. Therefore, a government reports the contributions as deferred outflows initially, and then at the start of the next year, the deferral is eliminated and the liability reduced by the same amount, with no impact on expense. If you look at the notes to financial statements related to pensions and OPEB, you will find a table that looks like this. It discloses the deferrals by their cause. All of the causes of pension and OPEB deferrals, except 2, can simultaneously have balances for both deferred outflows and deferred inflows. The deferral related to investment earnings, however, is either a cumulative deferred outflow or a cumulative deferred inflow. And the deferral for contributions after the measurement date always is a deferred outflow. The next part of this note then shows you when those deferrals are going to become pension or OPEB expense. A negative amount, like those here in parentheses, will be reductions in expense in the year shown. Positive amounts are increases in expense. You might notice that only 4 years are shown here, but we know that the earnings-related deferral is supposed to be expensed over 5 years. The explanation is that the first of the 5 years was the year reported in the financial statements, so only 4 years are left. This part of the note should always have at least 4 years if there is an earnings-related deferral. There will be more years if the average remaining service period is greater than 5 years. You might have expected to see equal expense amounts in each year, like the previous examples for leases and debt refundings. The reason they're not equal is that with each year, the liability increases or decreases again, adding to or reducing the existing deferral amounts, and in the process, adding a new layer of expenses to be reported in the future. Earnings-related deferrals for pensions and OPEB are not the only deferrals that serve the purpose of offsetting revenues or expenses to the point they might not be reported at all. The purpose here with these kinds of deferrals is not necessarily to see that expenses and deferrals show up in the right period, but rather to avoid reporting too much or too little in any year. The other deferral of this type that you may see, though far less frequently than pension and OPEB deferrals, results from a transaction called a hedging derivative instrument. A government might enter into that kind of transaction to protect itself against the risk of losing cash flows or asset values related to another transaction, such as buying an investment or issuing debt. It operates like a mirror image of the asset or liability, its value changing in the opposite direction. Despite the increases and decreases in its value over time, if it functions as it is intended, a hedging derivative instrument begins with no value and ends with no value, as you can see in this illustration. We get into this in more detail in the fifth and final short cakes video. Rather than reporting revenue in years when the hedging derivative instrument's value increases and expenses in years when its value decreases, a government reports deferrals in the amounts of the net increase or decrease. In this amount, the government reports a deferred inflow while the value of the hedging derivative instrument is positive, and a deferred outflow while the value is negative. The government's intention for the hedging derivative instrument is to protect it from loss as long as it has a related asset or liability. So increases in the derivative instrument's value during its lifetime are not resources the government can spend, and decreases are not costs the government will need to pay for, which is the reason they are not reported as revenues and expenses. Doing so would overstate or understate them and negatively affect your analysis of the government's financial health and assessments of whether it achieves inter-period equity. That's really as far as I dare go in talking about derivatives. The details are highly technical, and if I'm being honest, kind of boring. If you're interested, though, one of the resources in CRI's ebook, Demystifying Deferrals, is a slide deck that delves into the technical requirements of all types of deferrals, including those related to derivatives. Up to this point, we've focused almost solely on how to account for deferrals. We now turn to how that accounting information about deferrals should be reported in the financial statements. Governments are required to present deferred outflows in their own section with their own subtotal, following the assets section in the balance sheets, such as the government-wide statement and net position. Deferred inflows of resources are required to be shown in their own section, with their own subtotal following the liabilities section. Similar to assets and liabilities, deferrals should be reported by type. Governments can do so either in the financial statements themselves, or they can show a total amount in the financial statements and disclose the detail of the types in notes to financial statements. If a government wishes to include subtotals in the financial statements for assets plus deferred outflows of resources and for liabilities plus deferred inflows of resources, it may do so, but it's not required to. This is a typical government-wide statement of net position. And you can see the separate sections for deferred outflows following the assets and deferred inflows following the liabilities. In this example, the government has chosen to display only total deferred outflows and total deferred inflows. When this is done, there should be a note that breaks down those totals by type. Alternatively, they could have been disaggregated by type in the financial statement itself. This is a governmental funds balance sheet with a separate section for deferred inflows of resources. Again, since they are aggregated here, the required detail of individual types of deferrals must be disclosed in a note. You may have noticed that there is no deferred outflows section. That's because they are exceedingly rare in governmental funds, being limited to certain instances in which a government reports lending activity there. In the deferrals note, you may also see a disclosure when one of the components of net position or classifications of fund balance is significantly affected by reporting a particular deferral. For instance, if a government enters into an SCA with a very large upfront payment that results in recognizing a large deferred inflow, a disclosure might be necessary if that large deferral has a big impact on the amount reported for deferrals. Additionally, if the amount reported for a deferral is significantly larger or smaller than its related asset or liability, a government should explain how that affects net position and/or fund balance. Now that we've learned about which deferrals governments account for and under what circumstances, as well as how those deferrals should be reported in financial statements, we can talk about how to make sense of deferrals when you see them. We're going to focus on 5 of the things that deferral information is valuable for, though there are many other uses beyond these. Let's begin with how deferrals help to avoid misinterpreting financial statement items as assets or liabilities. You may remember way back at the beginning of this presentation, we talked about a liability that used to be called deferred revenue, and how only part of it actually was an amount owed by the government. Before deferrals came along, it also included things like future revenues and unavailable revenue, neither of which are amounts owed. What kind of impact did the transition to reporting those as deferrals rather than liabilities have? This slide presents 2 versions of a part of a governmental fund's balance sheet. On top is the version before GASB required the reporting and deferrals, and the bottom is the same information, but with the deferrals requirement applied. Compare the amounts in the row for the deferred revenue liability with the line below for advances on grants. The $1.4 million advances on grants liability is the only thing contained in the deferred revenue amounts that actually was a liability. The rest of the amounts were really deferred inflows. Now take a look at the amounts for liabilities with and without the deferred inflows included. The actual liabilities for the governmental funds in total were only half of what was previously being called a liability, 49%. As you might imagine, differences of that magnitude can greatly affect our views on the financial health of a government. When deferred outflows were included among the assets, it gave the impression that a government had more resources at its disposal than it actually did. On the flip side, when deferred inflows were included among liabilities, it gave the impression that a government needed more resources to pay off its IOUs than it actually did. Any financial ratio calculated using assets or liabilities might have given an inaccurate take on a government. For example, a simple leverage ratio is liabilities divided by assets. A leverage ratio indicates the extent to which a government's assets have been acquired through borrowing, such as an account payable, taking out a loan, or issuing municipal bonds. Generally, the lower the leverage ratio, the healthier the government is, all other factors being equal. To put it in personal finance terms, someone whose outstanding home mortgage balance is equal to 40% of the value of their home is financially healthier than someone with an identical home whose mortgage equals 80% of the value of the home. Using the information from the pre-deferrals governmental funds balance sheet that we just examined, that government is highly leveraged. It appears that the amounts it owes equal 82% of the value of its assets. The government's equity in its assets, so to speak, is just 18%. Calculate the same ratio using the post-deferrals information, however, and you can see that this government actually is much less leveraged than it appeared. Its liabilities equal just 37% of the value of its assets, or its equity in the assets is 63%. If one were to track a government's deferrals related to unavailable revenue over time, it may provide insights into the government's ability to collect on amounts it is owed. For instance, look at this 8-year trend for grants revenue and the deferred inflow for unavailable grants revenue. Recall that unavailable revenue is the amount owed to the government that was not collected during the year or shortly thereafter. Dividing the deferred inflow by total grant revenue for the year is an indication of the size of the deferral, a ratio that can be examined over time. If the percentage declines over time, it suggests the government is collecting a greater percentage of that particular revenue during the year, which is a positive development. By contrast, if the percentage increases over time, it suggests the government is collecting less of that particular revenue during the year, which is a negative development. A couple of things are notable right away from this information. In the first 5 years, the unavailable grant revenue is as large as half the total grant revenue for the year. That seems to suggest that it takes a relatively long time for this government to collect the grant money it's owed. That may be no fault of the government. The federal government in particular can take a long time to make payments on grants. On a positive note, there was an improvement in 2019 when the ratio dropped from 50% to under 43%. However, the ratio rises again in each of the next 3 years. Then, in 2023, oof, there is no unavailable grant revenue at all. What happened? Was the government suddenly able to collect all of its outstanding grant revenue? The amount of grant revenue in 2023 is about $4.6 million higher than it was in 2022, but more than $38 million of unavailable revenue has vanished. This is the kind of red flag that financial ratios may raise, pointing you towards something that needs further investigation. This is a real example of one of the schedules that governments present about their pension and OPEB plans. It presents the causes of increases and decreases in the net liability over time, the types of things we talked about that often result in reporting a deferral initially and then expense over several years. Looking at this information in connection with the note to financial statements on pensions and OPEB deferrals can inform us about how growth or decline in the size of the pension or OPEB liability will translate into more or less pension or OPEB expense in the future. We can see here that this government's net pension liability grew steadily from almost $114 million in 2018 to nearly $211 million in 2024, an increase of 85%. In 2025, however, the net liability dropped 21% to under $166 million. If we look at the individual changes in the total liability and fiduciary net position of the pension plan for 2025, we can see that the decrease in the liability is a result of a substantial increase in the plan's investment earnings from less than $3 million in 2024 to over $55 million in 2025. What will happen to future pension expense as a result of those notable changes in the liability? We can start to answer that question by comparing the pension deferrals disclosures from 2024 and 2025. In 2024, this government had a deferred outflow of $16 million related to the difference between projected and actual plan investment earnings. After the substantial investment earnings in 2025, the deferred outflow had become a deferred inflow of more than $37 million. One should expect that a swing of that magnitude will have a noticeable impact on future pension expense. Indeed, when we compare the 2024 disclosure of how the deferrals will be reported in future pension expense with the 2025 disclosure, the amounts are considerably different. The 2024 disclosure reports that the accumulated deferrals will add $13.3 million to pension expense in 2026. The 2025 disclosure, by contrast, says that just $306,000 will be added to pension expense in 2026. And in the next 3 years, what had been expected additions to pension expense as of 2024 are now deductions from pension expense as of 2025. The information that governments disclose about their hedging derivative instruments can be useful for identifying potential financial demands on a government's resources. In the example here, we see that in 2025, this government had a deferred outflow of $14 million related to one of its hedging derivative instruments. Technically, if for some reason that hedge were to be terminated, the government might have to pay that other party to the transaction the $14 million. Can it afford to do so? That's a good question to explore further. Looking at the same derivative instrument in 2026, the deferred outflow has grown more than 50% to over $21 million. In other words, the potential payout the government faces is even greater in 2026. That is a potentially valuable piece of information that someone examining this government's financial statements and its financial health going forward would be interested in. This presentation is just one of many free resources that CRI provides to help the public understand deferrals. In addition to this presentation, there are brief short takes videos, as we've mentioned a couple of times, that answer key questions about deferrals. There also are slide decks for all of the recordings, including this one, a companion slide deck that dives into the technical requirements of all of the deferrals required by the GASB, including debits and credits, a short plain language article that covers deferrals in a nutshell, a longer plain language article that delves deeper, and a third plain language article that explores how municipal bond analysts, taxpayer associations, legislative staff, and other users of financial statements can utilize deferrals information to evaluate a government's financial health, make decisions, and assess government accountability. And best of all is the CRI ebook that encompasses all of those resources and can be found on CRI's website at criadv.com. That brings to a close CRI's presentation on demystifying deferrals. We hope that you found it informative and that you are beginning to have a firmer grasp on what deferrals are and why it's important for them to be reported. Be sure to follow CRI on social media to hear about webinars, articles, podcasts, and other free resources about governmental accounting and other topics. And don't hesitate to reach out to me or any of CRI's other governmental accounting experts if you have questions or need help with understanding deferrals or any other aspect of GASB standards.